A sharp sell-off in AI-related technology stocks has rocked the markets, leaving investors questioning the return on their massive AI investments. Here's a detailed breakdown of what happened, why it matters, and what we can expect moving forward. Looking ahead, investors should brace for continued volatility in technology shares as the market grapples with the reality of AI spending sustainability. Over the past few years, the tech sector has enjoyed unprecedented growth, fueled by significant investments in artificial intelligence. However, as companies reassess their financial health amid rising interest rates and inflationary pressures, the sustainability of these AI expenditures is being called into question. The recent rotation into healthcare and equal-weighted indices reflects a growing cautiousness among investors, as profit concerns linger prominently in the tech sector. With upcoming jobs data and a tightening monetary policy from the Federal Reserve, market dynamics could shift further, creating additional challenges for tech valuations. Fed Chair Kevin Warsh faces the daunting task of balancing economic growth while curbing inflation through interest rate hikes. Market participants will be keenly observing economic indicators such as employment figures and consumer spending, as these could dictate the direction of the market. The uncertainty surrounding tech stocks is further compounded by geopolitical tensions and supply chain disruptions that continue to affect global markets. As a result of these developments, the question arises, will the tech sector rebound, or are we witnessing a fundamental shift in investment strategies? Investors may increasingly favor sectors perceived as more stable, such as healthcare, which has demonstrated resilience during economic downturns. Conversely, tech companies that can adapt and innovate in this evolving landscape may still present significant opportunities. In this context, the future of AI stocks remains uncertain. Investors must navigate a complex landscape of economic indicators and sector performance. The coming months will be critical in determining whether a broader market correction is on the horizon or if technology can reclaim its status as a growth leader. The market's trajectory towards AI-driven growth had been likened to a modern-day gold rush, propelling the U.S. economy forward. This surge was fueled by significant investments in technology firms, as companies raced to harness artificial intelligence to enhance productivity and innovation. However, this exuberance began to unravel as the anticipated profits from AI investments failed to meet expectations, prompting a reevaluation of valuations across the tech sector. Geopolitical tensions, particularly regarding the U.S.-Iran peace deal and subsequent military actions, further contributed to market volatility, creating an atmosphere of uncertainty that investors found troubling. Meanwhile, the Federal Reserve's tightening stance, led by President Kashkari, added additional pressure on the tech sector. Projections of interest rate hikes loomed large, raising borrowing costs and dampening the appetite for risky investments. These factors combined to create an environment of skepticism among investors who are now reassessing their positions in the tech sector. This reassessment is reminiscent of past tech booms, where initial euphoria often gave way to harsh corrections. The history of tech booms and subsequent corrections is well documented, reminding investors of the cyclical nature of markets and the necessity for sustainable growth. The current landscape reflects a critical moment in which the sustainability of AI-driven growth is being tested against the backdrop of economic pressures and geopolitical instability. Looking ahead, the outlook for the tech sector hinges on several key developments. Investors will be closely watching the Federal Reserve's decisions on interest rates, as well as the resolution of global tensions that could either stabilize markets or introduce further unpredictability. The capacity of tech companies to demonstrate tangible returns on AI investments will be crucial in restoring confidence and driving future growth. The recent sell-off in AI stocks marks a significant shift in market sentiment that has captured the attention of investors and analysts alike. Over the past few months, the excitement surrounding artificial intelligence has driven stock prices to unprecedented heights, fueled by the promise of transformative technologies. However, this euphoria appears to be waning as investors begin to critically assess the actual returns on their investments. The decline in AI-related stocks has not only affected individual companies, but has also triggered a broader market rotation into defensive sectors, with healthcare emerging as a notable safe haven for risk-averse investors. This shift reflects a growing preference for stability over speculative gains, as evidenced by the equal-weighted S&P 500 outperforming its capitalization-weighted counterpart. In a market where large tech firms once dominated the conversation, this trend signals a change in investor behavior, as many seek to mitigate risk amid uncertainty. The skepticism surrounding the immediate profitability of AI technologies could have broader economic implications. If tech valuations continue to falter, it could hinder investment in innovation and stifle job creation within the sector. For the average person, this translates into potential job uncertainty in tech industries that have been at the forefront of the digital revolution. As companies reassess their growth strategies, layoffs and hiring freezes may become more common, particularly in sectors heavily reliant on AI advancements. This downturn is particularly concerning as tech has been a significant driver of economic growth and productivity improvements in recent years. Additionally, the reallocation of investments from high-growth tech stocks to more stable sectors may impact retirement funds and individual savings, leading to a recalibration of financial planning for many households. The implications of this market shift could extend beyond immediate economic indicators, affecting consumer confidence and spending behaviors. Looking ahead, the landscape for AI investments may become increasingly cautious as companies and investors navigate these turbulent waters. The focus may shift from rapid growth to sustainable, long-term profitability, prompting tech firms to demonstrate tangible results and value creation. As the market adjusts, stakeholders will need to balance innovation with fiscal responsibility to ensure that AI continues to be a driving force in the economy. The future of AI may hinge on this delicate equilibrium, determining whether it can maintain its pivotal role in economic advancement or face significant hurdles in the upcoming year. On June 26, 2026, the S&P 500 closed marginally lower, heavily influenced by a steep decline in AI-related chip stocks. The technology-focused Nasdaq Composite suffered significantly, marking one of its worst weeks in a year. Stocks in sectors such as optical and memory hardware, which had previously surged due to AI enthusiasm, experienced a dramatic downturn. This sell-off was particularly pronounced among companies like NVIDIA and AMD, which have been at the forefront of the AI chip revolution. In contrast, healthcare stocks like Moderna, AbbVie, Eli Lilly, and Johnson & Johnson reached all-time highs, indicating a noteworthy shift in investor sentiment. This rotation from tech to healthcare reflects a growing skepticism about the immediate profits generated by AI spending amid rising interest rates and inflation concerns. The decline in AI-related stocks can be traced back to a broader reassessment of technology valuations. After a prolonged period of exponential growth fueled by investor excitement around artificial intelligence, many analysts began to voice concerns about the sustainability of these high valuations. The recent earnings reports from major tech firms revealed that while AI investments are substantial, the returns may not materialize as quickly as previously anticipated. As a result, investors are increasingly looking for stability and consistent profits, which healthcare stocks have historically provided. The impact of this shift is significant. With healthcare stocks outperforming their tech counterparts, a trend may emerge where investors gravitate towards sectors perceived as less volatile. This could lead to a more cautious approach in the tech industry, TVStinNet, where companies may be pressured to demonstrate tangible results from their AI investments. Moreover, the implications of this market behavior could influence tech firms to adjust their strategies, focusing on profitability rather than growth at all costs. Looking ahead, the market may continue to experience volatility as investors digest the implications of these shifting trends. The upcoming quarterly earnings reports will be crucial in determining whether the tech sector can regain investor confidence. If companies can provide clear pathways to profitability through their AI initiatives, we may see a resurgence in tech stocks. However, if skepticism persists, the healthcare sector may remain the favored investment choice for those seeking stability in an uncertain economic landscape. In light of these developments, What do you think lies ahead for the tech sector? Share your predictions in the comments below, and don't forget to subscribe for daily deep dives into the latest market trends.